Last year, we went from a multiple of 13.8 up to 17 on operating results. We've seen an increase in the multiple, I think, based on expectations that 2014 would see much stronger economic growth, a pickup in earnings expectations. So I tend to say that last year, investors focused more on faith than fundamentals, sounding more like Billy Graham than Ben Graham. Because they were waiting for the pickup in economic growth that would then justify their optimism.
If I could just add on to that. Let's think about where we were a year ago. We were coming out of something called the fiscal cliff, which if Congress didn't act, we would have had a fiscal drag of 4% of GDP and probably would have put us into a recession right away. We were still hungover from the debt ceiling debate of 2011. And there were very important changes that were made on January 1st, 2013, that took all of the tax cuts and made those tax cuts permanent. And it had two effects once we did that. The first is that it ensured that we were not going to have these large fiscal cliffs in the future. The reason why we had that is because we had temporary tax policy. Every 2 years, we would have to extend those tax cuts. Businesses and investors did not really have certainty or confidence. So we got greater certainty to investors and businesses. We eliminated these large fiscal cliffs. But more importantly, what we did was we put the country's budget trajectory on a better path, which is helping with cyclical multiple expansion. When we had a budget deficit of 10% of GDP, it's very hard for investors to say, I have confidence investing in the stock market, because you don't know how high the tax increases are going to be on you or how tough the austerity is going to be. So at the extremes, the ability to get the budget deficit down helped us on that first step to go from a 13 PE to a 17 PE. Now we need the earnings for the next step.